Hello there, hello. Thank you for stopping by the channel and welcome to WTF Mortgage. And thank you for checking out this video, which is going to be on a 30-year loan versus a 15-year loan. So let's go ahead and get right into it. So a 30-year loan, my opinion, a 30-year loan is best for those who don't have any specific plans. Like you don't have any specific time frame. You want to pay the home off. You just don't have any plans. You just want to get the lowest payment possible to get going, and maybe you'll make some plans, specific plans later on, but at the moment you don't have any specific plans. Now, on the other hand, a 15-year loan, that's typically for folks who have a specific plan. Like, for example, you're going to be retiring in 13 years and you want to have the home either paid off or close to paid off within that period of time, or for you want to save as much interest as possible and you can afford the monthly payments. All right, which brings me to let's say the downsides. There's not really any downsides, but let's just go ahead and bring up maybe a couple cons to it. And of course, the 30-year loan, while it gives you that great payment, it's a catch-all for everyone. You know, for somebody who does not have any specific goals, the 30-year loan, if you make all of those 30-year payments, like you stretch it out that long, you pay a tremendous amount of interest. So, I mean, that could be considered a con if you want. Now, on the 15-year loan, the con, if you will, about the 15-year loan is that monthly payment. Now, when you get a 15-year loan, you don't have a choice to make a lower payment like you can do on a 30-year loan. You know, you can make a bigger payment on a 30-year loan, as I'm going to show you here shortly. The 15-year loan, once you commit to that 15-year loan, you don't have a choice. The only way to get out of it is, you know, selling the house or refinancing or possibly doing a loan modification. Also, if there's maybe a change in the income, let's say you're a dual income household and with both your incomes, you're just fine. But if you were to lose one of those incomes, you can't really afford the 15-year loan. Or if you're a single income household and something happens to your pay, you have to switch jobs or whatever happens, and you can no longer afford that 15-year payment. So that's the possible, if you want to call it a con of the 15-year loan. Now, in some circles, they believe that the 15-year loan is amortized differently. It is not amortized any differently. It's the larger payment that saves the interest. And I'll show you that in a second here. So the 15-year loan saves a lot of interest, a lot more interest for two reasons. And reason number one is because of that larger payment, the shorter term on the loan. As you might know already, the longer you have a loan, the more interest that you pay. So that is the primary thing that makes the 15-year loan such a big interest saver over the 30-year loan, is that shorter term. Now, the other thing that has an impact on it is the lower interest rate. You will typically get about 1% lower interest rate, you know, depending on where you're going, what bank, what lender, what credit union, what brokerage. You typically get about 1% lower on the interest rate. And that percent does also shave you some time off the loan. Doesn't have nearly as big an impact as you know, making that larger payment to give you that shorter term, but it certainly does help. As a matter of fact, why don't I go ahead and show you right now. All right, so here we're looking at two schedules here. On the left side here, we've got a $500,000 loan, 30-year fixed at 6.5% interest rate. On the right side here, we have a 15-year loan, $500,000 at a 5.5% interest rate, you know, 1% lower. Now, let's look at the total interest. Oh, check out the monthly payments. Of course, you can see $3,160 on the 30-year loan and $4,085 on the 15-year loan. So let's look at the total interest paid, $637,722 on the 30-year loan, and a huge difference on the 15-year loan, $235,375. So that's a massive difference in the amount of interest that you pay. So let me show you what I was talking about in terms of the larger payment giving you that shorter term and the interest. So why don't we go ahead and make a 15-year payment with this 6.5% interest rate. So we're going to make an extra payment. So let's click on some extra payments here, and let's do monthly extra payments. It's going to be, should be like 925 and some change. I believe it is 925.08 should make this the same payment as a 15-year at a 6.5% interest rate. Let's go ahead and calculate, see what we get. All right, so let's come on down. And sure enough, we have 4,085.42, 4,008.42, same as the, I had a little tongue twisted there, same as the 15-year loan. Now let's check out the total interest paid. Drops down to $322,413, and you can see the 15-year loan. So you're still paying quite a bit more interest on the 30-year loan in this scenario because it's a higher interest rate. There are, in some circles, there are some folks that say interest doesn't matter. It's the paying it off as quick as possible. And as you can see, interest does matter. So even though it's I'm making a 15-year payment, the higher interest rate still, it takes a year and something to pay off more than if you just had the lower interest rate. So now let's go ahead and make it the same interest rate, 5.5%. Now it's a 30-year loan, or it's not quite a 15-year loan yet, because when I changed it to 5.5%, it lowered the payment down. Let me go ahead and calculate and show you what that is. So it's not the same payment yet. It's $3,764, which takes it down to $272,000 and some change in interest. So still more, because it's not quite a 15-year payment left. I'm going to have to add a little bit more to this to make it a 15-year payment with that lower interest rate. So 1246.47 should make it a 15-year payment. All right. So now we've got this 30-year loan at 5.5%, but we're making an extra $1,246.47, which should make it a 15-year payment. As you can see, it does here, $4,085.42, $4,085.42. Now check out the interest. $235,375 and $235,375. Over here you've got 34 cents and change, and over here you've got 11 cents and change. So what is that, 20 cent difference or something like that? But anyway, as you can see, it comes out the same. So there's no type of fancy amortization with the 15-year loan like some people say in certain circles. It's just the size of the monthly payment that makes the difference, and of course the lower interest rate. And that's one thing I would like to close with saying. So there needs to be a benefit, a big benefit or significant benefit to doing that 15-year loan in terms of the interest rate, in my opinion. If not, there's not a big enough benefit. You might as well just do a 30-year loan and make extra payments. And that is to offset or compensate for that risk. So for the risk of having that larger payment, I want a pretty good reward. There are some places you go to in some circumstances where the 15-year loan is not much lower than a 30-year loan, maybe a 0.25% lower, something like that. I mean, lower is lower, sure, but if I'm going to be taking on that additional risk of having the 15-year loan, I want more bang for the buck. So I want it at least a percent lower. That's just me saying it, to take on that type of risk. There's no math behind it. That's just personal opinion. I want as much bang for the buck as possible if I'm going to be stuck with that 15-year payment. However, I'll just tell you a real life example. In the past, what I've done is I just take the 30-year loan and I've made extra payments. That's what I do instead of being saddled with that 15-year loan. But if you have no problems affording that 15-year loan and you have those specific goals, absolutely go for it. Do that 15-year loan. Otherwise, just saddle up with that 30-year loan and make those extra payments, and it'll pay off in the same amount of time. Unless there's a difference in the interest rate, it's going to take a few months longer than a regular 15-year loan with a lower interest rate. All right. So that's the comparison on the 30-year loan versus the 15-year loan. And let me know if you have any questions on that. You want some specifics? This is just kind of a quick down and dirty. Drop any questions you have in the comments so I can answer those and everybody can benefit from your question. All right. So thanks again for checking out this video, and maybe I'll see you on the next video.